Hello and welcome to today's episode of Nucleus Investment Insights. Today we're going to talk about indexing and the extraordinary investment opportunities that indexes offer. The popularity and growth of indexing and exchange-traded funds has been astronomical in the past decade, with total funds under management and passive funds now exceeding active funds, and there's no sign that this trend is going to stop anytime soon. On the agenda, we'll explain what indexes actually are. Then we'll delve into the numerous index trading opportunities. Damien's informed me that there are now more indexes than stocks in the US, which for me seems hard to believe, but we'll dig into this in more detail and have a look at the facts. Next, we'll talk about smart beta indexes and how they work. Then we'll discuss the next generation of ETFs called direct indexing. This is growing exponentially overseas, and we think the same will happen here in Australia. Then we'll help you understand custom indexing. And as always, we'll cover the investment implications at the end. My name's Sam Kerr. I'm the Senior Financial Advisor at Nucleus Wealth. And today, as always, I want to welcome the Founder and Chief Investment Officer at Nucleus Wealth, Damien Klassen. Damo, welcome.
Thanks, Sam.
Excellent. So just a quick reminder before we get started, if you enjoy our content, please subscribe to our YouTube channel and click the bell below to be notified when we go live or have a new episode recorded. Alternatively, you can follow us on your preferred podcast platform, as our show's available on all the majors. And if you'd like to look at the slides in more detail, we'll post them in the show notes this afternoon, and you can view these at nucleuswealth.com/webinars. So now we've got that bit of housekeeping out of the way. Damien, I'll hand it over to you to get us started.
Yeah, thanks, Sam. So I thought I'd start a little bit basic, and then we'll jump into the more complicated stuff in a minute. But you know, this whole idea of what actually are indexes, and so I mean, really, it's just a collection of stocks that somebody's created some rules, and they're gonna buy those stocks for you. Or they're going to track the performance of those stocks, sorry, is a better way to put it. Then off the back of those indexes, often you get either managed funds or exchange traded funds, which will then create the actual baskets of securities and get out and trade those and sort of try and replicate the performance. So what's been happening over the last sort of 10, 20 years is this massive rise in terms of the amount of FUM that's actually in what you'd call passive assets. So following indexes and basically just saying, well, whatever the index rules are, that's what we're going to do. And we're just going to invest the money that way and take a much lower fee in return for that. And then, you know, with the view that lower fee can offset, you know, if there's any performance difference. And, you know, I think there's a lot of, you know, a lot of argument about, you know, who is the, you know, are active funds better or passive funds better, and all that sort of stuff, and lots of different places you can go to for the debate about that. I guess the issue for me is I always think about the market as being as needing to add up to something. So if you're out there saying, well, passive funds, you know, by definition, are always going to underperform by a little bit in terms of they're going to do whatever the index is, minus whatever their fees are and trading costs, and so effectively, you know, if you're buying an index fund, you're saying I'm going to do the average, whatever the average of the market is. There's some that come out and then say, well, equity funds underperform. And then they say, and then you look at the same types of studies that look at retail investors, and retail investors underperform by a lot more than that again. And then you sort of, and so, you know, I guess the pitch that some people have is, well, you know, these passive assets are the best, and that's the part that sort of sticks with me, is going, well, no, what you're talking about there is you're basically saying everything's below average, and so we should take the average one as being the best. And when you dig a little bit more into the numbers, is what you generally find is that the active funds tend to outperform, but then it's a question about how much they're charging. And so if you're paying, say, 2 and 20, which is like a common thing for a hedge fund, where the hedge fund takes 2% of the 2% as a fee, and then they take 20% of any outperformance, then they're, you know, they're probably outperforming for you, but they're probably taking all that back and quite possibly more than that in fees. And so it is that part about, I guess being aware that in those debates, the thing that always sticks to me is saying, well, somebody must be outperforming. And so if we know retail investors are significantly under, sort of about 2% per annum. And most of that is
Damien,
because bad timing.
what is that attributed to?
Most of it's to bad timing. Because what happens is when the stock market goes up, everyone feels really good and goes out and buys stocks. And when the stock market goes down, they feel really bad and sell stocks. And so, there are other factors as well, but that's the biggest one. And effectively, what when you think about it from a big picture perspective, is it might sound right. Is like, okay, I feel good because everything's going up, and so therefore I can buy, or I feel bad because stock market's falling. Things must be wrong. I might sell. Is effectively what you're saying is I'm going to sell whenever the market's low, and I'm going to buy whenever it's high. And so that's why retail investors tend to underperform. So we've got these indexes, and the question now is they've grown so big though that they're actually starting to make a difference in terms of the performance of the overall market. Now, there are people who will argue that because of the indexes, we're losing price discovery. So because the indexes they're very indiscriminate, they just buy whatever's in the index without regard to whether it's a good company or a bad company or whatever. It's just, if it's in the index, I buy it. And so the argument is that at a certain stage, these indexes are starting to push out the value of the price and starting to misprice assets. Now, I again have a bit of a problem with that argument in that, especially now, if we're talking about, there are more passive than active, probably. It is hard to judge with some of these ones, but there's still a lot of active people out there, and the active, you don't need. It's a matter of talking about, how much free float. So let's say we've got $1 billion company, and it used to be that 90% of the people investing in that $1 billion company were all active investors, trading with each other and trying to work out the right price, and only 10% were passive. And so effectively what you had was, $100 million was bought regardless, and $900 million was where you saw the price discovery. Now it's probably, $600 million is bought, but you've still got $400 million of people out there going for price discovery and trying to, and people shorting and long and all these types of things. So, in my view, it's a matter about what you think the free float of a company is. So how much of the company is actually actively traded, and as long as there's enough of that, that's where I think we'll still keep seeing price discovery within indexes. So, but having said that, there are a lot of things that pop up, and that's what a lot of this is about. Is a lot of what we want to talk about today is where do you get investment opportunities because of the rise of the indexes. And a lot of that is around stocks coming in and dropping out of indexes. And in a prior job, sort of a couple of jobs ago, so it must be. I was doing a lot of quant analytics and a lot of quantitative assessment of companies and quantitative strategy in terms of tactical asset allocation, which were the right sectors to be in and which were the right assets, bonds, and all that type of stuff like that. And as a bit of a side gig, I also did looking at indexes and what stocks were coming in and dropping out of the indexes. And even then, so this was sort of 8-10 years ago. Even then, to my embarrassment, I spent all this time doing this work for quant strategy, and then I'd spend a little bit of time on the indexes, and we used to get paid more as a broker, for the research I wrote on, what stock was coming into the index, which was sort of pretty much a simple calculation. And that's because there's now so much money on going in that what you're finding is sort of big publicly traded indexes. When stocks come in, it really pushes the price up, and that's where we get some trading opportunities that I'll go into a little bit more detail in a minute. But first,
hey,
I thought
Damien, we've just had a question from Andy Reid, and he's asking, what's your opinion on market cap weighted indexes versus equal weight index funds? And if you can just explain what they are as well, please.
Yeah, so basically what most indexes I'm going to talk about are market cap weighted indexes. So what that means is you buy the biggest stocks out there. And when I say the biggest stocks, it is a little bit of it's a little bit of a non-obvious definition of it, because what you do is you take the total size of a company, so how many shares are out there, and then what's the share price, and you multiply those together. But then what happens is we actually deduct off that any of the shares that aren't publicly traded or are owned by large shareholders that hold sort of big blocks. So if you've got, say, you're looking at Fox, and you might take off the Rupert Murdoch holdings off that. So you say, well, look, he's an insider. He owns all these shares, and him and his associates, and so they're not actually being actively traded. So in terms of the size of that company in the overall index, I'm going to exclude the Rupert Murdoch shareholders and just look at the shareholdings of the other people within that. So we're putting together indexes in that way. So it's basically all the biggest ones. So what you find is that if you're doing it as a size-based one, then you will definitely the performance of that index will be a lot closer to what the average investor is seeing. So because the average investor is investing, based on size, there's more people invested in a Microsoft or a Tesla or Google's, the biggest companies in the world, than what there is a much smaller company but still quite big, say like a WiseTech or something like that in Australia. So by overweighting those Microsofts and things like that in a portfolio, you get a better feel for what the average investor is doing. There are arguments about equal weighting, and a lot of that for me comes down to really what you're usually taking is a bit of a size bet, and because what's happening is you're basically buying more of the small cap stocks than what you're buying of the large cap stocks. So in a portfolio that has both say WiseTech and Google in it, you're basically saying, I'm going to treat WiseTech as being equivalent to Google and buy the same amount of shares as it. And so effectively what I've done is bought a lot more small cap stocks by doing that way. And there's it will vary as to when which one outperforms and underperforms. I think from my perspective, you generally find, it's not exclusively, but you generally find the market cap weighted stocks. What will happen is you'll get stocks that are more diversified on their own and tend to be lower volatility than small cap stocks. And they're usually higher quality and will tend to do better in downturns. When markets are really booming, though, that's when small caps tend to do the best. And so, equal weight versus market weight will, is a big issue with it is what type of market regime are you in? And so if you're in one way where you think you want quality and you're concerned about markets falling, or you're at least, you want some less volatility, then a market cap weighted index is more likely to be one for you. If you're thinking things are booming and small caps are going to go great, then an equal weighted index will probably perform better. But then again, in that situation, maybe you just go straight out and buy a small cap index anyway. So.
Yeah, Damien, I saw a chart comparing the returns of the equal weight S&P 500 to the market cap weight, and it was very similar returns. But like you say, the sequence of returns was very different.
Yes.
And with the market cap weighted index, you got so much concentration in just a few stocks these days. The Googles, the Microsofts, Amazons. Those big behemoths.
Yep.
Market cap weighted index. Maybe you got a bit more diversification.
Yeah. Well, and I guess it's the issue is really what are you trying to do? Because if you're benchmarking yourself, because if you're going to benchmark yourself against, say, the S&P 500, which is the biggest 500 stocks in the US, or say that the MSCI World, which is the developed market sort of benchmark, then they're market cap weighted indexes, and you're comparing yourself to those and see if you can outperform them, or if you can do better. If you're saying, I'm going to flip to an equal weighted index, then you're basically saying, well, I'm not sort of interested in what everyone else is doing in terms of a weighted average of the biggest stocks. Now I've got my own sort of index, and I'm stepping outside that. So, because that's, I think in the end, there's sort of, you can either measure yourself versus an index of what's actually out there, or you can sort of try and create your own index, or measure yourself to something different to what other people are investing in, and that sort of opens you up to, well, as long as you're happy with that benchmark, then that's fine. But you've got to recognize you've chosen a benchmark that's different to everyone else.
Yeah, and that's a good point. And I think it comes back to what your intentions are in selecting the investment.
Yeah. So let's talk first about some of the biggest global indexes. So there's a bunch of different providers. MSCI is probably the most common one out there in terms of benchmarked for institutional investors. And then there's the FTSE, and then there's Standard & Poor's or S&P. They've all got overlaps. They're all very similar in terms of the stocks that they have. The MSCI, which is the biggest one, they've got the most common ones. The ones we benchmark ourselves to as well is the MSCI World, which is about 1,600 stocks. It can vary. It makes up, I can't remember the exact number, but it might be 90% of all of listed stocks by market cap. And it's equivalent to about the ASX 60 odd. There's about 60 to 70 stocks within it. And it's developed countries only. Then you've got the MSCI Emerging Markets, which is about 800 stocks of the largest ones as well. And then a confusingly named, I think it's MSCI AC IWI Index, which they obviously love their acronyms. That's sort of got 9,000 odd stocks in it. It's about equivalent to about an ASX 200 and something stocks sort of sit within that index. So they're sort of your MSCI AC IWI makes up basically a global index of small, medium, and large stocks. Below that, so stocks that are outside the ASX 200, you'd usually call microcaps or at least some sort of word sort of below small caps. And those stocks, there are tens of thousands of them, but they're individually, you can add them all up, and they may sort of add up to maybe 1% or something like that of the overall size of the market, because for 10,000 of those stocks you get one Google share or something like that, or less than a Google, in terms of
lots of penny dreadfuls in those ones.
Yeah, that's right. And then you'll also see, so on the Australian Stock Exchange, they sort of classify things as being above the ASX 50, so above the top 50 stocks. That's the large cap part of the stock market. Between 50 and 100 is what they call the mid cap index. Between 100 and 300 is what they call the small cap index. So it's all a bit, it is sort of stuff a bit everywhere. But if you hear people talking about small caps and large caps, it can be they're very woolly lines. Each of the different providers all have different measurements, but within Australia it's that large caps is the 50 to 100 is mids, and then 100 to 300 is the smalls. And some of the other ones you might hear, that you sort of get a lot of different country indexes. In the US, sort of your most common ones is your S&P 500, which is your biggest 500. The Russell 2000 is the stocks that are in the small caps. That's sort of between the stocks between 1,000 and 3,000 in the US. So it's actually not the top 2,000 stocks. It's the stocks between the Russell 1000 and the Russell 3000. And then, a whole bunch of other ones you see elsewhere. It is worth noting that there are a couple of weird indexes out there. So the Dow, so that's the one which you hear a lot. So the US Dow, it's 30 stocks. It's actually price weighted. So it's not equally weighted. It's not market cap weighted. It's weighted by how big the price is, which once you actually sort of dig into it, is a really weird way of doing things. So for example, if you have a stock do a split, like we saw Amazon do, or like we saw Google do this year, where they might split their shares by 10. So effectively what happens is the share price was, say, $1,000, and then for every one share you got, now you've got 10 shares. So all that's happened is you've just got 10 times as many shares, but the share price has gone from $1,000 to $100. So in most indexes, that doesn't make any difference, because all that happens is they're looking at the number of shares times the price, and that hasn't changed. In the Dow, it does actually change. All of a sudden, you've now got you've taken away 90% of that stock's weight in the Dow. The Nikkei 225 in Japan is also price weighted, so they're very different. It's just this weird arbitrary number. So I guess where I'm getting to with those is that if you're looking at indexes, you genuinely want to measure yourself against. Those two aren't examples of stock of indexes you probably don't want to measure yourself against, and they're sort of more historical relics more than anything sort of useful that people trade off.
Hey Damien, we've got another question coming in from Cam, and he's asking, do you think it's correct that the rise of passive funds has reduced price discovery, which he obviously touched on, but then he's also asking about, do you think it's creating bubbles as well?
Yeah, I think there's I think it can lead to it, and that's probably some of the smart beta side to it that might be sort of helping to push that along. So in individual stocks, I think there are issues being created. As an overall market, look, I'm not as convinced. I think we've had lots of bubbles in stocks well before indices were part of the game. So I think they're certainly contributing in certain parts, but human beings are pretty good at creating bubbles. And if they weren't creating the bubble through indexes, say to tech stocks or something like that, they'd be creating bubbles in other ways. So there was I don't know. In the 70s, there was a nifty 50, the stocks you could just buy and forget about that were always going to be there, your Kodaks and your IBMs and all these, big McDonald's, all these big companies that were just like, yeah, they're great companies. They'll always be great companies. And there was a huge bubble in them. They just got so expensive. And a lot of them, well, a couple of those I picked didn't actually do as well. But, something like McDonald's or whatever fell in price, from that time, not because it got worse, but more because it just got so expensive at the time. So we get bubbles at all times. These will contribute, but as I said, but I think that's more about humans than it is about the actual indexes themselves.
Yeah, and it's very likely that capital was earmarked to go into the market anyway, and it's just going in a different form. It's going into
right.
Passive rather than active these days.
So if we look at the country weights, because that's so I picked this this really broad MSCI one, the MSCI AC World, IWI World. It's so you can see that about 60% of the market is still the US though. So even you got like whatever it is, almost 10,000 stocks, and the US actually only makes up might only make up 3,000 or 4,000 of those stocks. Like it's not. But because they're so large, and a lot of the stocks that you get listed in the US, they're notionally US stocks, but really they're global stocks. And so take something like a McDonald's. It's a pretty decent proxy for the world economy in terms of it's got restaurants all over the place, and that's where it generates its profits from everywhere. And then you get something like, I say, a Unilever that's listed, or part listed in the Netherlands and listed in London as well. But it's got heaps of its exposures in the US, and so despite the fact being listed there, it's a global stock as well. I talk about stocks in Australia, something like a CSL. It's a member of the Australian index, but the reality is it generates most of its revenue from offshore. And so it's really a global stock rather than an Australian particular stock. But if you look at this one, you can sort of see that US is most of it, Japan 6%, China, which for all the rise and GDP rise that it's had, its stock market is still only 3.3% of the overall. So emerging markets are very small relative to the rest of the world, and Australia comes in at sort of 2%ish of the globe, so not a lot when you look at that from that perspective.
Yeah, Damien, it's quite surprising that China is so small on the global scale. Considering there's 1.2 billion people and such a powerhouse in the world economy.
Yeah, so and look, a reflection of that, a lot of the wealth is caught up in their property market. A lot of the wealth is in state-owned entities and things like that don't tend to have a high valuation, and also are mostly government owned, and so they sort of get excluded from these. So that's a great example of you might find a stock that's a big Chinese stock that's some big state-owned entity there that it might have a market cap of $100 billion, but if 80% of it is owned by the Chinese government, for the sake of these indexes, they'll only treat it as a $20 billion stock, because they're saying, well, the free float of that stock is only actually $20 billion. That's the amount people can buy. And so we're not going to judge it as being $100 billion as part of the market. So some of it's that, but most of it is just that China just doesn't have that much wealth in the stock market. I mean, the other one that's interesting that doesn't even make the grade here is Germany, because a lot of the companies over there are privately owned as well, and so it's a question a little bit of for a very big powerhouse economy. It doesn't you'd expect to see. Or it's the amount of shares listed in Germany is lower than what you'd expect based on the amount of trading it does and the amount of its size in the world economy.
That's interesting. And why do you think that is? In Germany, that
the private companies, largely private companies for that.
Yeah, but why do you think that is?
Oh, an historical. A lot of family-owned companies. I think the legal structures there are probably more conducive as well to that. And also I think the companies in Germany also often have they've got more of a I don't know, might call it a social compact with the economy, in terms of saying that the workers need to benefit. Workers often sit on the board, so it's not just the companies aren't acting just for shareholders, whereas the US is probably the most capitalistic in terms of that point of view, and in terms of saying, yes, the shareholder is king, and so the company's job is to maximize shareholder wealth, and if that means screwing over your employees and your customers, then so be it. Whereas I think the German companies are a bit more circumspect about making sure that things are shared equally shared more equally between workers and shareholders.
Yeah, that's interesting. Thanks for that.
The other one I wanted to highlight is some of the sector indexes, and so and particularly Australia versus the world. So I've got some sort of pie charts up, but I'll pull out they're probably a bit small to be seen on screen. I'll pull out the most interesting parts. So Australia, you look at financials plus materials plus real estate, and you get basically 50% of the market between those three sectors. In the global market, financials are less than 15% of the market. Materials are 5%, and real estate's 3%. So you end up with well less than half of that in the globe. So Australia, if you're buying Australia, you are buying a big exposure to financials, and you're buying a big exposure to materials, and in particular resources, which is an even smaller proportion of the actual overall material sector. So I think it's worth noting that you're just by buying the Australian market rather than buying, say, a global index, you've made a big asset allocation decision, or a big sector allocation decision just from that decision, to go heavily overweight financials versus the rest of the world, and heavily overweight resources versus the rest of the world. I think resources might be 1.5% maybe of the global indexes. Mining stocks. Mining stocks might be 1.5% of the overall global index, and in Australia they're more like 15 to 18% or something like that. So it's dramatically different. The other thing is the IT sector globally is about 20%. Now that doesn't necessarily include there's lots of stocks that aren't in there. I think Amazon's not in that. Google and Facebook aren't in that. They're in communication services. So this it might not be all the stocks you sort of think that sort of automatically pop into there. Or Netflix, isn't into that information technology. So that's 20% of the globe, the biggest sector there is. For Australia, the IT sector is less than 3%. So you're sort of getting, not quite 10 times less exposure in Australia to that IT sector than what you would get overseas. Very different market, and so keeping in mind that if you're just going to buy an Australian index, you've made some pretty big sector decisions incorporated in that decision.
Yeah, just one thing to note on that chart. I've just noticed the colours don't exactly
No, they don't
match up across the global and the Australia.
No, they go from largest to smallest. Yeah.
Yeah.
Apologies, that's they're both from the MSCI. So thanks for commenting on my charts there, Sam.
Sorry, I noticed.
I agree. If I had to put it together myself, which I probably should have, they should be the same colours. Anyway, let's talk about this index trading. So where are the trading opportunities and investment opportunities from this? So a lot of it is this index entrance and exits, and you can the amount of stock that can turn over can be well north of 10% of a stock when it comes into an index now. So some of these major indexes, especially if it's jumping into multiple indexes, you might see 20% of the stock of the available stock turnover pretty much on the day that it goes in or out of the index. So it's a massive difference in terms of makes a massive difference to the value of that stock and who owns it. So the thing is, though, if you wait for the announcement, you miss out on most of this, most of the gain, because what happens is most of the gain happens that the announcement gets made. Share prices all adjust pretty quickly. Hedge funds get out there and buy these stocks so they can then sell them back to the index providers. So because a lot of the exchange traded funds or the strict index ones, they basically need to buy it on that day. So they need to wait to the very last day, and then they go, new stock. Tesla's just entered the S&P 500, and a couple of stocks have fallen out. They have to wait until the very last day and then sell a bunch of things, buy Tesla, and then off they go. Now they will try and do deals with others to make sure they've got the stock available, depending upon what their trading rules are and things like that. And there's also a lot of index players who don't have to be as strict. They can sort of try and time it a bit more around the edges. But I guess the thing is there are some massive changes, and so and that's what as in a previous life, as I said, I used to get paid more for trying to predict these entrants than for a lot of other research, just because there's hedge funds out there who are basically trying to front run these and work out. And they are they're quite simple, the calculations you do. You basically just need to track a couple of things I've got there. The three main ones, the four main ones is your market cap changes. So stocks are getting bigger versus getting smaller. Almost always there's like an average calculation. And so it's not just a matter of saying, and it's working out when they do the assessment. So MSCI will do it over a 3-month period, and it's a different 3-month period to the 3-month period that S&P will do. And so there's all different things like that. There's basically a buffer zone is the best way to think about it. So if a stock's trying to get into the ASX 50, it probably needs to be rated pretty close to about the 40th biggest stock. It might even be the 45th, but yeah. Anyway, it needs to be rated very high in terms of you can't just sort of go, oh, this stock's now number 50. It's going to kick out a stock and come in. It actually needs to get a reasonable buffer behind it. And then the same for stocks falling. If a stock falls and now it becomes stock number 51, it won't get kicked out of the index. It actually needs to fall a fair bit further before it will actually sort of drop out. And so I sort of would think about it as, some stocks will be forcing their way into the index and other stocks will be forcing their way out of the index. But depending upon what's happening at the time, there might be a big new listing and there's a stock that's now in the ASX 50 is now, ranked number 35. And so it's definitely going to force its way into the index. And the smallest stock might only be number 51. And so it might actually drop out of the index, even though it wouldn't sort of, wouldn't drop out of its own accord. It's just the lowest one on the list. And so S&P will kick it out. Whereas MSCI is actually quite different. They've got sort of a different way they do it, and they'll just add it. They might just add that stock and not actually drop any stocks from the index at the time. So you've got that happening. You've always got stocks being taken over, and so needing to find new entrants. Most of them have sort of liquidity constraints on them as well, so they need to different, and all these all the providers have different rules about the liquidity and how they measure it. So, but basically, you just need to make sure that there is enough stock trading that people can buy it. MSCI will use some of the rules about foreign shareholders. So something like a Qantas that has rules about how many foreign shareholders it can have. There might be limits for whether it can be in or out of the index. That major shareholding thing I spoke about, that makes a big difference. So sometimes what you find is a shares, and then that will actually increase what I spoke about before, the free float. And then all of a sudden, because of free floats increased, it just jumps straight into an index, often at quite a high weight, because it's all of a sudden there's all these extra shares out there available. And then time, like if it's a big new listing, it won't necessarily go straight into the index. A lot of index providers will make sure that it might need to be around for 6 months or 12 months before it's built up enough trading history. But having said that, they'll often every now and again on massive sort of new entrants, they'll make exceptions and put things in. So so a lot of different moving parts, but again, there's pretty good trading profits for hedge funds, which is why they look to do it. But keep in mind that if you're seeing the announcement that XYZ stock just went into the index, and then you rush out and buy it with the view that 20% of it's going to turn over, in 3 weeks' time, you've probably missed the upside. There's it might still go up for other reasons, but the actual trading part of it, most of that happens before the stock, before the actual announcement gets made by these index providers. So some of the other opportunities, though, is that there's because we spoke about the smart beta, and I'll go a little bit more into detail about the smart beta, but there's later on about some of the strategies. But it's worth noting that there's a lot of exchange traded funds out there that end up holding very concentrated portfolios or very concentrated holdings of particular stocks. So you might have, say, a dividend stock portfolio in Australia, and it might end up holding, 5% of a stock like Fortescue, because it pays such a huge dividend. But Fortescue is a type of stock that's quite volatile in terms of whether it pays a dividend or doesn't pay a dividend. And so it's the type of stock that can very quickly go from being in one of these indexes to not in one of these indexes. And when it does, you might find that all of a sudden, 5% of the stock gets sold because an ETF had, a big ETF had happened to, with a smart beta strategy, it happened to build up a lot of exposure to it. There's also, so a lot of people, you can download all this data from exchange traded funds, like you can get the holdings that they have, and there's a lot of people sitting out there doing this analysis in terms of trying to work it out. And some of the funds that they got big for a while, they're probably not quite as big now, but there's some minimum volatility funds, they're called. And what they try and do is they try and buy stocks that are with low volatility. And so it's sort of it's a bit of a weird feature of stocks, that if you can buy these low volatility stocks, in theory, under the CAPM, they should give you a low return, but in practice, they actually give you a higher return. The issue in a smart beta fund is you might have a stock that jumps 20%, and that's actually enough volatility to get it kicked out of the minimum volatility index. So a good event might actually lead to this stock then getting kicked out and then falling back as 2 or 3% of the stock gets sold because it's dropped out of a smart beta index. And they've all got different timings as well, but the bigger hedge funds will track a number of these ETFs and what stocks are in there and what stocks, look at the rules and try and work out what's going to happen in terms of stocks getting kicked out. And that can flow through. I've got a return on equity, but there's it's probably more of a shorthand for saying financials. So companies report their earnings, and that then changes which portfolios, some of these stocks, some of these smart beta strategies about how much a company makes in terms of returns, or how much it makes in terms of its price to earnings ratios or its dividend yield or whatever it is. But things can change, and the market participants can clearly see, people who are following it can clearly see, oh, right, this stock no longer fits the criteria to be in this smart beta strategy. And we know that the fund that follows that, rebalances every month on the 30th or whatever, and so then they can, or often it's usually more quarterly or semi-annually, and so they can sort of front run and go, okay, I know that that stock's going to drop out and it's a big holding, and so sort of try and manipulate them to a certain extent. So that's sort of the main trading opportunities in it. There are then investment opportunities with all these as well, and I'll talk about that a little bit more sort of on some of the later slides in terms of the what the smart beta things do and the other things, the other sort of investment opportunities you can get, as opposed to sort of how can you trade these things. So the next one, we spoke about this. Are there more indexes than stocks? And absolutely, yes, there are. Now, I couldn't find any updated data on this, but so this is sort of from 5 years ago, was when it first went that way in the US, and it is definitely worse than this now. So in the US, there was whatever it is, 4,000 odd stocks in 2016, and that was sort of the first year where indexes shot past them. And there is and that hasn't changed. Like that the growth in indexes has been as extreme. They're now much more easy. The computing power makes them much more easy to calculate. All the index providers are trying to do custom indexes for various clients, and so what that sort of means is that there is now there's more. I guess in the end, the way to think about it is there is more. There's more ways you can put together stocks. So if I have 10 stocks, I can put those together in a whole bunch of different combinations of ways, and so I can end up with far more than 10 different permutations and combinations. And so I guess that's the way to think about these indexes, and largely they're these indexes are they're getting more and more customized the further you go down the list.
And Damien, with the more indexes than stocks, is that tradable indexes like ETFs, or is that just indexes that S&P and MSCI, these types of companies have made up?
That's just indexes that all these other MSCIs and S&Ps have made up. The tradable one's not far behind though, and actually it's probably in front. Would it be probably in front? It's probably in front. So I've got another chart with the just the ETFs in the US. So, and that's I've got that a little bit more, got a few more years in there, but that's sort of over 2,000 ETFs, and the 4,000 odd stocks that we saw. Then there'll be unlisted trusts, and so almost without a doubt that would be more than the more tradable instruments there than the number of companies. So it's and think about it another way is each one of those things has an investment fee on it, and the financial markets love to charge an investment fee, and if we can slightly alter one of them and charge an investment fee to people, then that is what investment market participants will do. So that's the the growth has been dramatic, and the number of, I had a chart obviously at the start. I don't think I've talked about that, but the amount of money in funds has obviously grown beyond, in these things has now grown beyond the active ones. So that's sort of, it's probably better to talk custom indexing here. So a lot of the reason for the rise is that these index specialists can just make these. They've got all they've built tools effectively now to just make them quite efficiently, and it means they can come up with quite unique strategies. And so I went to an S&P thing earlier on in the week, and they were talking about how they've got, they were using an example of an advisor who wanted 5% of their money in crypto, and so they had an asset allocation strategy that was part bonds, part equities, part cash, part crypto. And that was their specific one. They want to see if they're outperforming or underperforming versus that. So, and at that point, you can have any one of a number of different, things in terms of, well, is it 5% crypto, or is it 7% crypto, or is it 3%? And all of a sudden you've got just created yourself 3 new indexes, or whatever it is in terms of a whole bucket of new indexes that you can then you can then use. So the good thing for that is, it does help measure some of these sort of more unique strategies. But the bad thing is there's definitely the potential for just index shopping, where people sort of go, well, I've gone to S&P and I've got them to create me this index that sounds good, but there's a structural flaw to it that I know is much easier to outperform, and therefore, that's what I'm going to measure myself against, something that I think I can outperform and potentially collect a performance fee on, or whatever it is. So the more indexes, obviously they can they can cater for more accurate and better measurement, but there's just as much scope for them to just create complexity that managers can hide behind. So then I wanted to talk smart beta. Unless there's any, is there any questions we should hit up in the meantime, Sam?
There's a few comments rolling through. No specific questions at the moment. So Cam, excuse me, he's saying there's lots to consider about exchange traded funds, especially with the exchange rate risk when buying overseas ETFs, and he's saying also the hedge funds, they can sort of charge higher fees on those and on certain spreads.
Yeah, absolutely. There's there's exchange traded funds sort of there's definitely some really good exchange traded funds out there with very low fees, but the problem is they sort of trade. There are funds as well, sort of trading off the good name of other hedge funds of other exchange traded funds in order to be able to charge quite high fees, and the market making side of it and how they're crossing the spread and things like that can really make a difference in terms of how an ETF trades. So, and what I mean by that is there can be bounds. So if you buy, like, say, a Vanguard S&P 500 fund, there's lots of people trying to arbitrage, lots of market makers who are all out there trying to arbitrage it down to the last few cents. And so you're going to get a good price because they're all fighting with each other to take your money and go out and buy the stocks at the lowest possible price. If you go into some of these more illiquid ones, there can be quite wide spreads, and so you might be losing a couple of % on the trade to get in because of that. And depending upon how the currency is done as well, as anyone who's used a bank for foreign currency, that's where banks love to make some extra margin, is by just giving you a really crappy exchange rate on foreign currency. And so that's often a risk as well that you need to look at for your if you're buying some sort of more esoteric exchange traded funds, that maybe there might be issues in terms of how they're trading.
Cool. That's the only sort of comment we've just got at the moment. So let's move on to smart beta.
Yeah, actually, sorry, I might answer the one about the Vanguard S&P, so the Warren Buffett one. Sorry.
Oh, yeah. Okay. So, I missed that one. Chris said he saw an interview with Warren Buffett, who suggested the best long-term investment was a low-cost, low-fee index fund, such as a Vanguard S&P 500. And Chris is just asking, he'd appreciate your opinion from an Aussie perspective.
Yeah, look, I think there's Warren's saying that while managing his own money because he thinks there's some benefit to active management. But I guess what he's saying is if you're not sure and you're worried that you might get ripped off, then an exchange traded fund like a low cost index fund is a pretty good option. You're going to get average performance, and it might be more volatile, but it's for people who aren't particularly interested and just want to buy, set and forget, then that may well be a good strategy. And we offer a number of those types of ones to people who don't want the active management. They can just jump in and get the passive side. So have no problems with that. We have products ourselves for it. I think the main one I just want to highlight for an Aussie investor is that if you're doing that on the ASX, just noting that you are getting this massive exposure to banks and a massive exposure to resources that you wouldn't see elsewhere. And in any other country, if you turned around and said, "Oh, I'm going to I've got a portfolio. I'm going to stick you in. If you're a US investor, Sam, and I'm sitting in the US, and I'm saying, and I'm going to buy 15% resources for you or 20% resources as part of that you'd be like, oh, taking a huge swing at the resources sector, and if you get it wrong, I'm off suing you because you had too much exposure, because I had too much exposure to resources. And possibly similar in financials. If you came back to me and said, I'm going to fill a portfolio with 50% banks and 50% 50% banks and 50% resources. In Australia, that's just your market portfolio. In Europe, you put a client in that and it goes wrong, and you're getting sued for malpractice. So I think that's the thing to note for Australia is, do you want that exposure to banks and resources? And then sort of consider whether there's other ways to get your exposure, your lower cost one. And actually, that's probably a good intro for later on. We'll talk about direct indexing. We'll speak about some ways where you can, much easier ways to do it through direct indexing, which is a sort of newer technology that we'll talk later on in the podcast about.
Yeah, and Damien, in the Aussie perspective, do you have any view which is sort of better with the ASX 200 or the ASX 300? I mean, with the 300, you're likely to get more small caps.
Yeah,
do you think it makes much difference?
The reality is, once you get like the top 20 something stocks makes up 80 or 90% of the index anyway. So really, when you go to the ASX 200, you're getting diversity in terms of the stocks, but they're not making much difference to your overall performance. So so in a lot of the ones we'll do as a direct index, we'll run sort of 25 or 30 stocks for the Aussie, and the performance is not significantly different from what you're going to see in the 200. So I guess what I'd say is for people who are interested in particular stocks in the 200, it's this idea of having this core. If this is like your core portfolio that's saying, I just want to get that because it's going to get me most of the performance of the market, is a smaller one is just as good as, or not just as good, sorry, but it's not significantly different to some of the larger ones. And then if you've got particular stocks you want to own or particular sectors, buy those ones around it, as opposed to saying, I'll just take one of everything with the view that, hopefully I'll get some stocks that go well.
Yeah, that's a good point.
Okay, so let's talk some smart beta ones now. So, and these have sort of been described by people quite aptly as dumb beta plus smart marketing, because it's a lot of smart beta ones. They're these mathematical models that come out, and they're there to help generate performance. And you get some pretty good names from whether it's the quality indexes or the value indexes or the growth indexes or whatever it is. What they're trying to do is they're trying to dig in on a factor, and they don't always work, but they usually do. And it's worth noting as well, as I've said in a few of these, there's sort of this implicit assumption about that whatever your stocks you're buying in these won't, that there's it's a non-reversionary thing, and I'll get into that in a minute when I talk about a few of the examples. So the problem with a lot of the smart beta exchange traded funds that you get is that, yes, you're getting exposure to the factor you wanted, but the smart beta ones are fixed on they've got a very fixed formula, and they need to have a very fixed formula so that they're telling people, look, this is what we're going to do. And so the formula might be volatility of earnings or something like that, and it's some just mathematical formula about the volatility of the earnings. And then you get a pandemic happen, and you might get a stock that has a massive fall for a month or two and then a bounce back, and it happens to report in that section, and and whatever happens to its earnings, and it gets kicked out of the index. And another stock that didn't happen to report in that time period, and so might have suffered exactly the same fall, but because of the mathematical nature, sort of gets kicked out, doesn't get kicked out. And then somebody who's more active with it or following those strategies can look at those and cater for the differences. Sometimes these smart beta ones, though, they just sell it because that's what it is. That's what happened, and that's what the model says, and so it has to go out. Accounting standards change, and some of these things keep running the same models. So they had something that was like, here's a successful measure of, say, return on equity that generates quality or whatever it is, and then the accounting standards have changed for what constitutes equity, and the smart beta the smart in inverted commas beta strategy keeps doing that strategy, even though the accounting standards have changed and they won't work out for another 10 years, that this strategy no longer works because of the accounting change. But that was the formula they started it with, and that's the one they're going to keep going with, because otherwise they've got to change the whole constitution, and it's a real hassle and all that type of stuff. Whereas somebody who's following that strategy from a more active point of view would then say, well, if I'm trying to buy quality stocks and the accounting standards change, then I'll change what I'm going to do. But the first question I always ask with any of these strategies is whether you're selling insurance to the rest of the market. And what I mean by that is it's the book The Black Swan sort of explains this in a lot of different ways, but a lot of it is about saying that there are strategies out there where you're providing liquidity to everyone else in the market, and that by doing that, you're effectively selling insurance against a negative event, and everyone else in the market is saying, I will pay you, Sam, $1 a day to take this risk for me because I don't want to take it. And you're sitting there going, hey, isn't this fantastic? I made $1 today, and I made $1 the next day, and $1 the day after that. And look at that. Over the last year, I just made $365. How easy is this? Every day I win. I never lose. It just keeps making this money. And then one day, all of a sudden, you lose $10,000 on the trade. And you're like, oh, I've been running this for 10 years, and I'm thinking about what a great thing it was, and how I've back tested over 10 years, and I can see that you would have made $3,650. And then I've lost 3 times that in a couple of days on it, because effectively everyone was saying, I don't want to take this risk, that something, a big negative event happens, but you were the one taking that. And so, so that's always the question. So especially when you get some of the, you get some fancy black box strategies, and they're all about, short gamma, long gamma, weird deltas, and all these things that are sort of option pricing terminology and lots of Greek letters. You need to be extra careful in those ones, because often they are. And we saw a few of those blow up a couple of years ago, when and just go to zero, like these ETFs that just effectively went to zero and closed up, and then we're back out, a few months later, making lots of money on those same trades, but because it's sort of like an insurance type product. And so, so every time, ask that question. But, I've just got a couple of examples. We've done some other quant ones on here, but I've got the 5 biggest sort of quant factors that you usually see out there in terms of number is momentum. And basically that's that stocks that go up are going to keep going up. And so what you're assuming in that is that there's no mean reversion. So I'm making an assumption that this is going to keep on going forever. And, it usually won't. And momentum is usually one of these strategies that does very well at making small amounts and then all of a sudden giving back a lot. So, it is a question of timing for that one. But these are, and the other one, it's trading costs as well, because it's a high turnover strategy. Low volatility is that same thing. I'm buying stocks that have a low volatility, and they're going to keep being that way. Buying growth stocks that are growing strongly with the expectation they're going to keep growing strongly. Quality stocks is the same. I'm buying them because they're quality, and I think they're going to stay high quality. But value is actually the opposite. So value is basically saying I'm buying stocks that are cheap, but I expect them to become more reasonably priced over time, so that they will actually mean revert. And so you get different price effects on these different strategies. But I guess we've done other podcasts on it, but I guess the overall part is there's some interesting strategies you can get from these, and often you can get factors that I actually quite like to get exposure to. Trying to find stocks that have got growth and a good mixture of growth, a good mixture of quality, and a good mixture of value is exactly what I do all the time in terms of trying to pick stocks. The issue is, would I like to set up a formula today based on back testing and then never change that formula ever again? And I'd say no. Absolutely not, because I know accounting standards will change, and I know things will happen. Companies will automatically start trying to game these mechanisms and the things that they know everyone's using. And so that's my main issue with smart beta. And I've just got a chart up that shows a few some of the performance you get from it, and it really can change. particularly say the value one. I've just put up that as a top one on that chart. So you can see that what we're looking at is the year so far, the year to date. And so if you had bought the cheapest stocks and sold the most expensive stocks, you would have made about 12% so far this year in terms of valuation. But you can see as you go back in time that that's one strategy where you make 12% one year while everyone else is losing money, and then you get a year like 2020 where you lost almost 30% of your money on that while everyone else made lots of money. And then again in 2018 and again in 2015, where you have these periods where sometimes these strategies can really diverge from the rest of the market. And so it's making sure that you're buying them for what you think is the right reason. So you might be buying value stocks because you do want to own value stocks, not just as a I've heard sounds good, I'll buy some now. It's like a question about is there a market timing element, because you're effectively making a decision not to own the other stocks, and that's so effectively you're taking that's I guess the dichotomy or the incongruence in these is in a way you have people telling you active managers can't outperform the market, so just buy the value factor and forget about it. And you're like saying, well, that's an active decision. By just buying the value factor, you've actively made a decision not to buy other stocks in the market. And so I guess that's probably enough on smart beta. Direct indexing, though, that's probably the key one I wanted to cover off on is so this is exploding in the US at the moment. You can see I've got a chart up here just showing how much funds are in direct indexes. Sort of hung around about 100 billion for a few years back there in the sort of mid-teens, and it's sort of 350 by 2020. I think it's over 500 now, and there's talk about it. There's a number of people with estimates thinking it's going to hit 1.5 trillion well before the end of the decade. Sort of, I think over the next 2 or 3 years, actually, they're expecting it to sort of hit maybe 2025 to hit those levels. So it's been huge in the US. I've got a list here of all the big guys in the US are all buying out the small fintechs. So Charles Schwab, Goldman Sachs, Morgan Stanley, BlackRock, JP Morgan, Vanguard, Franklin Templeton, PGIM, all these big names, Fidelity, have all either created their own or most of them have actually bought existing players in the market. And so it's clearly an area that all the big guys think is going somewhere. It's clearly an area that investors are embracing. And for us, it absolutely makes sense as to why people would prefer to have a direct index rather than an exchange traded fund. And so what is a direct index? So that's probably the first question it's an index where you start with the index itself or some sort of index, and then you actually customize it to what you want. And so it was exactly what an example of what we do for people in it is you can either use our own, you can either do it to our own actively managed portfolios, or let's just say you wanted a passive portfolio and you're an Australian investor and you're like, well, I want to invest in Australia, but I actually don't want to be 50% banks and resources. I'd like an Australian portfolio that's a bit more, that's weighted a bit more like a normal one. And so you can come in and cut stocks out or cut sectors out and say, okay, I'll take the Australian index X banks and resources, and I'll buy those separately. Or you can do all the ethical screens over the top, and you can say, okay, well, actually, give me the global index, but I don't want anything to do with carbon in that. Cut out any of the carbon stocks, or cut out anything to do with nuclear or war or whatever your own personal feelings are on those ones. And also, so that's one part of it. You can also then add in some tax strategies in terms of actually being able to sell some of the losers and actually harvest some of the tax losses, or investors in the US can do that. Australia is a little bit more limited in terms of what you can do, but there are tax strategies that are available in Australia as well. And we're looking at adding in some ones now to our portfolios, and you do have them in a lot of the overseas ones where you can start adding sectors as well. So saying, okay, well, I'll take a global market, X X tobacco, X carbon, and I want some extra technology stocks in there. And so, that type of thing is possible. And especially if what you might find is people who already own their own business in a particular area. Let's say you've got a business and you're a property, you're in the property market. You might decide that, if you own your own property, you're in a business that's in property as well. You don't need property in your investments. You've already got enough in that in your personal life or other investments. So on your share market, you just cut all of the property sector completely out of your portfolio, and maybe banks or something like that as well. So, direct indexing, it really does give this customization part where you can still rely on sort of professionally managed portfolios, but without having to do everything. And so, it's the part about saying, well, you could do this by building up this with a stockbroker or setting it all up yourself. But the issue then is you've got to then manage that portfolio and make sure that when stocks drop in and drop out and corporate actions happen and all this other stuff goes on, that you're actually still in the portfolio you thought you had. Whereas with a direct index, you're saying, I want the 25 or the 40 largest stocks in this market. You manage that for me, but just make sure you don't buy any carbon stocks or whatever it is you decided to cut from that portfolio.
Yeah, and Damien, just one other distinction I just want to add is with a traditional exchange traded fund or index, you just buy one security and the manager's buying all the underlying securities. Whereas the direct indexing, you actually own all those stocks individually. And that's what really gives it that ability to customize it and, add things and align it to your ethical values and beliefs, or, have those sector or asset class tilts.
And the tax benefits as well of that, because what you tend to find is that, and this is a very big one in the US because the tax laws are a lot easier about it. But you can still do this within Australia to a certain extent, but it's not as easy as in the US. But in the US, why they've exploded so much is because you can say, I want to harvest all the tax losses. So buy me the top 70 or 80 stocks, and then sell the 10 that have the biggest tax losses every year, and then buy them back, 6 months later, or put them put those into similar securities, and then put me back into that index fund in a few years' time. So you can have these strategies that actually get you that sort of harvest those capital gains for you every year, and sort of get you that in the US you can. For some of your earnings, you can use it like negative gearing. You can sort of write it off against your actual income. But within Australia, there's obviously benefits as well, just in terms of being able to say, well, I've got capital losses that you sort of you've got there to offset your capital gains at a later stage. So I've got a table up just sort of showing the most common ones. So there's 4 different ways people use it. One is for these tax focused strategies, which does generate greater returns for your portfolios on an after tax basis. If you're in the right, depending upon what portfolios. Obviously, if you're in pension mode in Australia, then you're not getting any tax anyway, so that doesn't sort of benefit you. But for other more high tax paying ones, the personalization, so you get all these the social governance and the ethical screens you can do, and other types of factors. You get all the rules based strategies. So if you want some extra quality in the portfolio, or you want some extra value stocks in the portfolio, you can sort of, under different ones, you can add these sort of rules-based strategies in, so you get those in the quantity that you like, and then the whole customization part about this, we see people who have got, say, they're a banking executive and they're investing in that, and they're not allowed to invest in their own stock, and they already get stock as well as part of the options plans, and they don't want to invest in competitors because they're banking exec with lots of exposure to that sector already. Is they go, okay, well, give me the index, but cut out all the banks, so that they can they can see that the portfolios have been truly customized to their own investment needs and thought about as part of the greater pie, versus just saying, hey, I'll take an ETF that's just got all these things in it anyway.
Yeah, and that's a good point with what we do, Damien, is you have the ability to exclude Australian banks. So if you're bearish on the Australian housing market, for example, or you just don't want that over concentration in financials that the Australian market offers, you've got the
or you already own the banks
really
in your own name. And you know,
Yeah.
there's a lot of people we see who get, you know, they've got shares as either they bought it, you know, 20 years ago, or they've got an inheritance or something like that, and they've got those shares already sitting there, and they're like, well, I've already got lots of banks, and I don't want to sell those ones because there's these huge capital gains baked in for years. So, you know, let's not double up on everything. So some of the other benefits you can get from them, you can actually do fractional shares for some of the US and European now. So we're sort of rolling that out. And it's quite common in the US, but yeah, we're rolling that out now over the next, you know, few months for Aussie investors. You've got that thing about, you know, how much personalization you want. You can go active, you can go passive, you know, take your pick on that. Fees is obviously important. You know, the fees we're sort of looking at on some of our newer products, depending upon how much you put in there, can be sort of as low as sort of 20 basis points type thing for if you're putting lots of money into it, but sort of start at sort of 38 basis points for passive. So the types of fees you pay are pretty commensurate with I guess what you pay on a lot of specialty ETFs. So not the, you know, if you're just buying the S&P 500, for example, you can get that for sort of, I don't know, 3 or 4 basis points probably. But if you want some of the tax efficiency and customization, then sort of paying sort of 20 or 30 basis points for it is a pretty, yeah, it's commensurate with, say, buying an Australian ETF, which would be priced around that same amount, or buying, say, some of the global ones, might cost you more. Like a European ETF is in that range anyway. So so the fees are pretty cheap on these, mainly because it's all technology driven nowadays. So it's much they're certainly much more accessible. But I guess where I'm getting to with indexes is the overall part of indexes. There's some interesting parts to it. For me, the ability to customize it is the more interesting part for investors, and that's what you should be thinking about as direct indexing solutions that are out there. Is looking at these and trying to work out how can you use these direct indexes to not only get the benefit of having these indexes and low fees, but actually incorporate it into the other things you're doing and actually have something that sort of fits your own investment profile better.
Yeah, great. So we've had a question from Cam, another question from Cam. So he's asking if it's possible to build a short direct index, and in particular for some sectors of ASX indexes.
Not that I know of, but there's certainly ways to end up with the same effect. So the issue is if you're going short, if you're doing a short index, short across a short index by building up the individual stocks, the problem you generally get is it's difficult to manage short positions, and you can get calls on them and things like that. And if you've got to manage 100 different positions and the cost to borrow and is different on others and all that sort of stuff, it can become problematic. Whereas it's quite easy to go short the index. There's lots of products out there that allow you to go short an index quite easily. So I think what you may find is easy to do is go short the index through futures, for example, and then buy the stocks that buy the sectors that you like. So put together, say, for some sort of custom clients of ours, we've sort of put together managed sort of high net worths. We've put together sort of managed discretionary accounts where we might be, we own a big chunk of the index, but we're underweight specific sectors, say banks and resources or whatever it is. And then we're short the index on the other side. And so the net effect is very similar to being short those, it's the same as being short those particular sectors, but you've just built it up a different way because it's much easier to manage and much, much easier to manage and generally would end up being lower cost than going short all those individual stocks.
Okay, that's a great answer. So this is the last call for any final viewer questions before we get into the investment implications. So just drop them in the chat below and we can answer them after this segment. So now we've got the viewer question of the week. So this is for viewers to have some discussion in the comment section over the coming days. So the question for this week is, which investment strategy is your preferred for the second half of 2022. So feel free to post your thoughts and engage with us and some of the other viewers over the coming days. And Damien, I'll pass it back to you for investment implications.
Yeah, so I guess I just wanted to recap some of the sort of investment side of it that is worth sort of thinking about. So there's trading opportunities around the indexes, but I just want to highlight to people that don't. And there's big trading opportunities, but don't think about it as, I've just seen this announcement that the stock's coming into the index, therefore if I rush out and buy it, it'll be successful. That once the announcement's out, it's too late. You want to actually sort of be preempting those. The quality versus value versus growth argument. So these are the three sort of biggest that I'd sort of something that if people are doing their own asset allocation or at least sector allocation, they should be thinking about how they're exposed on these ones. So what tends to happen with them is, when the economies are booming, is the time to be, overweight growth stocks. When you're worried about sort of later stages of economic of downturns and sort of early stages of upturns, you probably want to be in quality stocks. And value stocks, generally the best performance comes from them at the late stages of the boom, where traditionally stocks that are lower priced sort of end up being coming up to better value, like we've seen recently, where say your banks and particularly a lot of the energy stocks have done really well sort of at the late stages of cycles. And so thinking about how that fits and what your exposures are to those. And that can be, with some of these indexes, you can either see what your exposures are or more actively manage it through ETFs or direct indexes. This idea about active versus passive, taking your choices there, and if you are going to be passive and choose that because you've made a decision that active managers can't outperform, then at least acknowledge then if you are taking a bet on, say, a growth index or a quality index, is, well, you've actually made an active bet yourself. So thinking about what are actually the implicit bets, and then also the part about taking an Australian index, for example. You've taken a heavy exposure into banks and resources. As long as you're comfortable with that, that's fine. But at least you're acknowledging that you're taking a very different exposure to what investors might else. Is the whole idea about large versus small caps as well, and it's sort of that same idea in the quality value, is that you'll find large cap stocks tend to do better in trouble, and when there's times of trouble and in early stages of recoveries, whereas small caps, when you're talking about stocks starting to boom, that's when small caps generally do better. And then certainly have a look at direct indexing. There is it is, as I said, trillions of dollars are ending up in that overseas, and it's because it's effectively the second, ETFs 2.0, as I think we've been terming it, is there's plenty of opportunities to provide extra value and extra customization to investors to fit better with the rest of your investments, and hopefully give you a more appropriate exposure.
Excellent. Nice one, Damien. So that almost wraps us up. So thanks again for putting on the show, and really interesting episode. I'm sure lots of people got lots of value out of it.
Thanks, Sam.
Excellent. So we do welcome your feedback on the podcast, especially in regards to suggestions for future topics. If you do have if you do have any ideas, please drop it in the comment section below, or send us an email at contact@nucleuswealth.com. Just a reminder, this is general advice and does not take into account your personal situation. If you do want to discuss your personal financial situation or direct indexing, please go to our website at nucleuswealth.com/contact, and you can book a call with me. Don't forget to like the video now. And finally, if you know of anyone that might get some value out of today's episode, we'd really appreciate it if you can please share it with them. And also, if you'd like to see more of our previous episodes and content, head over to nucleuswealth.com/content. And to stay up to date with us and news from us, you can also follow us on all major social media. So for myself, Damien, and the rest of the team at Nucleus Wealth, thanks for watching, and we look forward to seeing you next time. Bye for now.